Good morning and welcome this morning to Trading Index Options, another great webcast from Schwab Coaching. My name is Ben Watson. I'm an education coach and senior manager here at Charles Schwab. I'm joined out there in the chat by my good friend Cameron May, 20-plus year veteran of the financial markets. He's there to help answer your questions, and I'm also joined by all of you. Whether you're here in the live version or the recorded version, we're glad to have you here with us. Make sure that you participate in the conversation. If you're here in the live version, be a part of the chat, ask some questions, be a part of that conversation that's going on there. If you're in the recorded version, leave us a comment in the comment section, and we will reply to that as quickly as possible. So we're going to jump into the discussion here. Today, we're going to take a look at our 14 days till go until expiration, 7 days to go until expiration strategy that we've been working on for a while. We're also going to talk about the fact that many of the major indexes are breaking out or have been breaking out, maybe reversing or pulling back a little bit here just in the last few minutes. So we'll see what that looks like. And we'll also talk about the idea, if there is a little bit of a pullback, how traders may use index options to hedge a portfolio. So we'll jump into that here really quickly. Before we do that, however, a couple of quick housekeeping items. Remember that everything we talk about is simply for illustrative and educational purposes only. This is not a recommendation of any particular security or strategy. Remember that investing involves risk, including the loss of principal. Past performance, no guarantee future results. Dividends aren't guaranteed. When we talk about index options, we generally don't have to worry about that. Speaking of index options, when we talk about equity and index options, remember that those carry a high level of risk. They are not suitable for all investors. Make sure that you're aware of the characteristics and risks of options before considering any transaction in the options world. You know, the index options that we're going to be focusing on are all European style options, which means that they cannot be exercised until expiration. That differs from the typical equity option, which is generally American style. There are some differences. There are some exceptions to that, but most equity options are American style options. American style options can be exercised at any time up until the expiration date of the option, and therefore, when you are short American style options, there is the potential to be assigned early. Trading index options that are European style takes away that early assignment risk. So one of the reasons why we talk about trading index options and some of the strategies that we use. When we consider those strategies, be aware of the fact that if you were to move the same strategy to an American style option, there is that potential for early assignment risk. So we're going to use technical analysis in this discussion. There are lots of different ways to look at the market: technical analysis, probability analysis, fundamental analysis. None of those are guarantees. All of those are theoretical in nature. Schwab doesn't recommend these technical analysis. This is the sole means of investment research. We're going to be using the Thinkorswim desktop software platform today, specifically the paper money version. Great learning environment, great sandbox to practice in. It is not, however, a guarantee of future success out there in the real world. So let's talk a little bit about where we are headed this morning. We're going to jump right over here to the Thinkorswim desktop software platform. And as I do that, a couple of quick reminders. One, you can follow me, you can follow Cameron on X at Ben Watson CS, at Cameron May CS. You can follow all the other coaches there as well. Same kind of naming convention. We'd love to have you there, because if we're not talking about things in the webcast, we're posting about it in an X post, putting up videos over there as well. So we've got a lot of great content there. And the other thing I'm going to ask you to do is click on the subscribe button down here at the bottom. That subscribe button down here at the bottom is going to connect you to the Trader Talks webcast page. Make sure that you stay part of that conversation. And as we do that, that is part of the part of being that community, right? It's a no cost to you. It allows you to set alerts on new content, and it helps you to find our content faster, and helps other people to find content faster as well. So we're glad to have you here with us, and glad to have you do that. Let's take a look at the indexes right now really quickly as we get started, talking about that idea that maybe there's a little bit of a breakout in the indexes. Yesterday was a big up day in the majority of the kind of the three big indexes that we look at: the SPX, the NASDAQ, and the Russell 2000. A little bit of a breakout yesterday if we look at it relative to where that previous resistance was. right here, in this case, around the 64.23 level. Breaking out yesterday, continuing that breakout today, although this candle, which was green earlier, is now rolling back a little bit. Taking a look at the NASDAQ, a little bit more solid pullback here in the NASDAQ. Nevertheless, a bit more of a solid breakout yesterday. So 2 steps forward, 1 step back. It's kind of the Paula Abdul effect here, right? So seeing that move to the upside and maybe a little bit of a pullback and rolling back just a little bit. The Russell, on the other hand, the bigger of the 3 movers, and this is unusual. This has done something unusual. Over the last few weeks, we've been seeing the Russell. Last month, we've been seeing the Russell kind of just doing some piano keys, kind of black and white here, green and red candles up and down right around this resistance level. Pulls back a little bit into that confluence of the 2 moving averages. Now we have the 200 period moving average still going sideways, the 50 period moving average for the first time in some time, making the golden cross and crossing from below to above the 200 period moving average. Not that that necessarily means anything. It doesn't mean that there's any kind of pot of gold here associated with that. That is just simply an indication that intermediate term movement is moving faster than longer term movement. The golden cross oftentimes can be kind of a misleading signal because it generally comes after there has been a pretty big run up. Nevertheless, we kind of see the Russell 2000 breaking out a little bit here above those ranges. And so we're seeing that continuation today, the RSI moving a little bit higher. So that being said, this is kind of what I want to get to in this discussion. We're going to take a look at a couple of strategies regarding the Russell as it is currently moving. That's kind of been the biggest mover, perhaps the greatest amount of implied volatility here at this particular point. But nevertheless, let's take a look. And again, we'll take a look. I did this in the trading futures class yesterday. We hedged against some downside movement in the NASDAQ, and in fact, it went against us. The fortunate thing is we closed the trade down. Today, we're going to look at potentially hedging a portfolio against that NASDAQ move, as Carol's talking about, perhaps rolling back a little bit. Now, is it the appropriate time to hedge? We'll talk about it. We'll talk about why maybe it is or isn't. But the next thing I want to do here really quick is I want to jump to our VIX grid really quick. We haven't talked about the VIX for a little bit. And by the way, I just wanted to say thanks to Connie Hill for filling in for me last week. I appreciate that in this class. So taking a look at the VIX, we're just going to zoom in over here on the right-hand side. The VIX continues its summertime grind down into these lower depths of the 15 and into the 14 handle. We're at 1469 today with a little bit of green popping up, but nevertheless, this grind, and this is typical of the VIX. This is the typical nature of the VIX into summertime, into a normal summer. It normally digests information pretty quickly. Yesterday, we had an up day and a down VIX. The day before, we had a kind of a different scenario. We had an up day and a slightly up VIX, and that can happen when there is maybe a little bit of bullish speculation going on, and call options become a little bit more highly priced as there is some speculative pressure. But that's not a very common occurrence. But again, starting to see the VIX grinding back down into these lows around that 14.7 handle. Take a look at the VIX relative to the SPX, and we can kind of see that relationship here moving in opposition. And then the VVIX, and I haven't moved these numbers for a little bit, but this is something interesting. So as we start to see the VIX continue to see the VIX grind down into those lows, notice what's starting to happen, however. The VVIX, which is the volatility measurement of the VIX itself, is starting to increase. And as that volatility measurement of the VIX itself starts to increase, that's a circumstance that can potentially be a precursor to VIX movement. It doesn't have to be, right? It just simply says, hey, volatility is cheap. Maybe institutional investors are starting to buy up a little bit of protection, buying some protective puts against some of the indexes. Not enough to really cause the price of the VIX to move yet, but you can start to see that volatility variance increasing just a little bit. And it oftentimes comes as a result of a move of volatility, or the volatility of the VIX below that VIX line. This one, in this case, that volatility spiked, or the volatility spike that we saw about a week ago. I mean, minor though it was, created a little bit of maybe uncertainty. And we're going into September, into the Fed meeting that has some potential volatility impacts as well. So all of this kind of plays into the landscape. Speaking of the landscape, the landscape in the chat just changed a little bit. We have a feedback survey that has just dropped into that chat. Do me a favor, if you wouldn't mind, help us out. Fill out that feedback survey. Go ahead and click on that link. Open up that site that opens up, set it aside, come back to the webcast, and then you can go back and you can fill out the survey at your leisure. If you want to wait, you can wait too. That's fine. Just don't miss the opportunity to fill out that feedback survey, because that helps us out immensely in making these sessions better for you. And that's the best resource that we have for that. So I want to do one thing here as we get into this discussion, going back to that SPX. So the three things that I really want to focus on today are 14.7 strategy, movement on the Russell, and hedging against that NASDAQ movement. So let's talk about that. Let's go to our monitor tab. Let's open up our index options weekly trade here. And again, thank you to Connie for helping out last week. I placed the kind of rolling trade last week, and here's what we ended up with at the one standard deviation line. So I ended up with 61.40, 61.20 short put spread. It now has 7 days to go until expiration. Sold it originally for $1.80. It's currently trading for $1.12, and it's gone from 10 cents to now 15 cents, very likely because of that just very slight increase in implied volatility, that VIX popping up just a little bit and the SPX rolling back a little bit. Am I okay sacrificing 15 cents for the sake of collecting the majority of the gain in this trade? Absolutely. So that's the structure. We're going to buy this back come what may, right? So we sell it at 14 days to go until expiration, buy it back at 7 days. This is an illustrative and educational experiment that we've been doing. This is by no means any kind of a recommendation about a strategy that you should employ. But what we're going to do is we're going to close this one down, and we're going to see what we can get that for. We're going to see what we can buy it back for. I'm okay buying it back for 15 cents or less, and that'd be fine. Let's see if we can get it for 15 cents. So I'm going to click on that closing order, make sure that this order is to close this vertical spread down, and we're going to click on send, and we're going to fire that order off. We got it for 15 cents. That's great. So against that $1.80, we sacrificed 15 cents to close that down. We got the majority of the move that could make for us. And that's kind of the process. Again, 14.7. And what we're doing, for those of you who have not been with us before in this structure, so let me show you a little bit about the reason why, and I'll just do this really quickly. The reason why we're doing this at 14 days to go until expiration and then 7 days to go until expiration is this. The vertical spreads that we are selling are ending up around the 15-cent delta, roughly, on the short leg. What that means is these are going to be far out of the money. The behavior of far out of the money options when it comes to time decay changes a little bit. So if this axis on our option premium here is option price, and this axis is time till expiration, the normal time decay curve that we're normally used to seeing looks like this, right? It's that logarithmic curve. That's the at the money strike. At the money strike. Well, we're not talking about the at the money strike here. We're talking about, let me just do this again really quickly here. Let's close those animations. Let's now put this one back on. Now what we're talking about is the out of the money strike. So if it looks like this is the OTM. It tends to look like this. The rate of time decay is greatest in the initial period from entering the trade, and as it gets closer to expiration, that theta sensitivity tails off, as opposed to the theta sensitivity of an at-the-money option. And the reason for that is theta's overall curve, if we were to look at in the money versus out of the money, that theta curve looks like this. You're familiar with that. So that means that ATM is right there. OTM, ITM is right there. This curve represents sensitivity to theta. So for far out of the money, low sensitivity to theta. Far in the money, low sensitivity to theta. Right at the money, greatest sensitivity to theta. And that's the reason why we do this in terms of this structure, in terms of this trade. So that's just a quick primer for how we put this trade together. So the next step in this process is to go back to our charts, and I'm going to bring up a grid that I've got that we've built for this purpose. It's my index. Where did it go? There it is. Index options grid. And on the left-hand side, we've got a 1-year daily chart. Right-hand side, a 3-month daily chart. We've got on here on this chart a 200 period simple moving average. That 200 period moving average still moving up, and the price of the index still above that 200 period moving average, which means we're going to be selling put spreads. If this were below, like it was way back here in April and May, we were selling call spreads because it was bearish. We had a bearish trend. So now the next thing that we do is we come over here to the right-hand side. We've got this probability of expiring cone, which is a 1 standard deviation line extending out, or a cone of 1 standard deviation levels extending out from the current price of the stock or the index. And we're going to take a time hack here. I'm going to remove that one. We're going to just double check against this. We're going to say 14 days to go from now is the 27th of August. So now we're going to go back to that chart. We're going to say, where is the 27th of August? And I'm going to use my time level tool in my drawing tools, and I'm going to go out to the 27th of August. That's right here. That's 2 weeks away. And we're just going to put a time hack there. And then I'm going to draw my time or my price level here at that intersection. And I'm going to say, all right, just kind of right there, 62.85 is the intersection of those 2 points. My 1 standard deviation line and my time hack. And so I'm just going to draw that line in there. Now, one of the things you notice, and I've left each one of these levels in as we've continued to sell, you can see that sometimes when implied volatility is high, we get a little bit further away. When implied volatility is lower, we get a little bit closer. When implied volatility is really low, we get a little bit closer each time that we put that trade on. So now here's price. Here's where our trade's likely to be. You can see the width of the 1 standard deviation curve, and that's where that level is going to be, 62.85. So we're going to go to the trade tab. We're going to go out to the 27 August expiration. And we're going to find the put spread, or the put strike in this case, that is at the 62.85. There's the 62.85. I'm going to change my layout to delta theta vega so that we can see that. 62.85 is about the 15-cent delta. 15%, that's the approximation. 15% probability of this option being at or in the money at expiration. So that means it's got a pretty good probability. 85% probability of being out of the money at expiration. That's exactly what we want to have happen here. So we're going to look at selling the 62.85, and we're going to make this 20 wide So we're going to buy the 62.65. We've been making these 20 wide. Okay. We've been making these 20 wide. So what that means is 20 wide, our expectation is that this is going to decay away, right? That this is going to get as worthless as we can see as quickly as possible. 1 week, right? The risk to reward here is a little bit unbalanced, and I want to address that really quickly in this case. So we're bringing in $1.70, which is a little bit less. It's 10 cents less than we brought in last week for this trade. Different level, implied volatility's gone down again. So I'm not expecting to get the same amount of premium in this particular case. Plus, we had a big up day yesterday, which pushed the price up, pushed us up in that probability range as well. So what we're going to do is we're going to sell this, and we're going to look at buying it back at 14 days. So we click on confirm and send, and we're going to read through this order. I'm going to put this in our index options weekly group, and we're going to say, all right, make sure that this is to open. Make sure that this is what we want, 62.85, 62.65. Bring it in $1.70. Our max loss is about 1,830. That's what we're going to have to. That's good. The impact of the buying power effect. That's going to be the possible max theoretical loss, and we have taken max theoretical loss in this trade a couple of times, especially when there's been that crossover when prices crossed from above to below that 200 period moving average. So I want to address Steven's question here. If we were do something like this strategy on the minis, like XSP, for instance, the premiums are going to be smaller slightly, and the liquidity may be less, right? So we're going to buy back in 7 days. We're going to buy back at 7 days, Vic. So and the reason that we don't take this all the way out till expiration is because it's diminishing returns, just like the one that we saw today. We sold it originally for $1.80. We bought it back for 15 cents. Why would we want to spend the next 7 days trying to pick up an additional 15 cents when it's already picked up a fair amount of its premium, right? The majority of its premium. So we're going to go ahead and click on send. Now, to Kelly's point, this is really not a very delta sensitive trade, right? We're not terribly directionally sensitive because we're so far out of the money. I'm going to go ahead and send this order off, and we'll see if we can get this filled while we're talking about it. But we'll talk about what that net delta is, right? So if we take a look at the net delta is the 62.85, 14 cents minus 12 cents that we're long. So we've got 2 cents of net delta. Okay, we sold it for $1.70. That's good. 2 cents of net delta. I don't care very much if the price of the stock moves as long as it stays above my short strike. My theta decay here is positive theta decay to the tune of about 8 cents. You can see that I've got $1.28 and I've got $1.20. And my Vega sensitivity in this particular case is about 20 cents or so, maybe 18 cents. So if implied volatility goes up, that's going to help our long leg. It's going to hurt our short leg. And so it kind of gets us to that point of saying, look, this is a trade that becomes that is benefited by that passage of time, and the passage of time quickly. It's benefited by a decrease in implied volatility, and it really isn't hurt or helped by much of a move in terms of the price moving one way or the other. Really, truly isn't. And again, that delta is going to move, and then we're staying out of kind of that last week to go until expiration gamma movement as well. So that's the trade that we've put on here in terms of that expectation. All right. So that's our 14-day to go until expiration, 7 days till expiration trade. Somebody asked if I can send this index grid so that I will do that here really quickly. Let's do this. I'm going to share this grid, and we'll click on share. Now, anytime we share an item here in the chat or in a webcast, and this is also in the description of this webcast, remember that it is not guaranteed as to time or accuracy. and it is for illustrative and educational purposes only. All right, so let's come back to the two other things that I wanted to do here in this discussion. One was take advantage of that movement on the Russell 2000. So let's go back to our charts here, and actually let's just put in here RUT, the Russell 2000. And so what we're seeing is the Russell 2000 making that move to the upside and continuing in maybe a little bit more bullish perspective. We have the MACD kind of turning bullish here. We have a breakout of a resistance level. We've got a resistance level overhead. So my thought was, in terms of taking advantage of this bullish movement, that we might create one of two strategies. And the one of those two strategies that we might look at would be a diagonal spread. The diagonal spread being a longer dated long option in this case and a shorter dated short option. And since it's moving in a bullish direction, it would likely be a bullish call diagonal spread. But I also had another thought here as well. Given the fact that implied volatility is relatively low, what if we were to use that idea that if implied volatility were to move and ramp up, what if we could perhaps benefit from that a little bit more? Now, a diagonal spread is going to have some net benefit from rising implied volatility, but it's going to suffer from time decay. Now, there are ways that we could create this spread that would kind of help us to accomplish that. So let's look at a couple of different ways that we could do this. What I'm going to do, Jerry says, when do you consider political activities to manage your trade during a 7-day waiting period? Well, the same way that you would manage that with any index trade, right? I'm not necessarily concerned. News is going to be news, and what that news is going to move the market. So we're playing the probabilities. I don't know, neither does anybody else, what political activities or economic activities are going to do to the movement of an index in any particular time period, let alone with any kind of precision in the 7-day time frame. So I do know where there are planned events, FOMC meetings, data releases, earnings announcements, if you're talking about an equity, those types of things. So those are things to plan around. But hypothetical political moves, I'm not so worried about, because I can't do anything about it, right? So it doesn't make any sense to hypothetically plan or talk about what kind of impact they might have. We're going to take the trade off at 7 days, whether it's a winner or a loser, right? So that is the strategy. So BJ asks the question, what's in that 14-7 strategy? What's the highest delta that we'd sell? It depends on where implied volatility is. If implied volatility is really low, it's going to bring that in a little bit. So it's primarily determined by the one standard deviation line as opposed to specifically the delta. But the higher, just in general terms, the higher the delta, the lower the probability of success in the trade in that particular case, since we're selling that vertical spread. Now, let's kind of put this trade together here on the Russell 2000. So our expectation is bullish. We can do this one of a couple different ways. So I'm going to go to the trade tab for the Russell 2000. Now, there's one thing to think about. I mean, this is a pretty expensive index. It's 2307 is the index value, and then we times that by the multiplier, and we get our notional value. And when we start to look at this then in terms of the price of these options, I've got 100 strikes showing because I used that for our 14.7, but I'm going to make this a little bit more easily manageable. Let's put it down to 50 strikes. These are still relatively expensive. If we were to use something like the MRUT, the mini Russell, we could do the same kind of thing, but you can see the magnitude of the prices on those options is a little bit smaller, right? This is 1/10 the size of the big index. So Rory asked the question, how do we find standard deviation? I use the probability of expiring cone to put that on the chart, one standard deviation. So what I'm going to do is I want to create a trade here that gives us some duration, but also takes advantage of the fact that there is that upward movement in the trade. So we'll do this on the big index here first, RUT, Russell. So the first thing is I want to do this. I want to go out and give myself a little bit of duration, a little bit of time in the long leg on this diagonal spread to let that trend continue to move. Now, I know that I've got an FOMC meeting. I know that if that FOMC meeting returns some results that are beneficial to small caps, the small caps are likely to go higher. So I want to be outside that range. So I'm going to go actually 64 days to go until actually in this case, I'm going to go to this one, the 30 September, which is the quarterlies. That's going to be the regular monthly expiration, but it's also going to be the quarterly expiration. That's mechanically no different. It just expires on that third Friday of September. So there's that 30 September expiration. Bid-ask spreads are pretty narrow, relatively narrow, but these are expensive. So what I'm going to do is I'm actually going to go in about one strike to the 2290. Index is currently 2307. I'm going to go into the 2290. A little bit higher delta. It is going to be a little bit more expensive. And that's going to tie up $8,380 per contract. So we're going to keep that there, but we're going to buy down the cost of this expensive long option. Now, here's the thing. This long option, look at the Vega sensitivity. For every percent that implied volatility goes up, that's going to add $3.26 of implied volatility value, of extrinsic value to this option premium. That's got a pretty substantial, hefty Vega number. That's why I want implied volatility to come up. That's why I want to do this type of strategy when implied volatility is low and rising, because it's going to benefit that long leg. Now, what I want to do is I want to look at selling a little bit out of the money here. Now, the idea being I want price to continue to move up. If I were going to do it right here, that's going to be a vertical spread. I don't want to do it in the same expiration. I want to be able to roll this strategy 2 or 3 times. So I'm going to come back here where there is a little bit of still some implied volatility. I'm going to come out here to the one that expires in 5 days from now. Okay, 5 days. And I'm going to look at selling that one that expires in 5 days. But what I want to do, notice the difference in the implied volatility impact. If implied volatility were to go up, that's going to hurt the short leg, but it's going to help my long leg. So I'm not losing some of that volatility sensitivity. And what I want to do now is maybe take a look at where this is likely to move. So expected move based on implied volatility is about 40 points. So if we're at 2308, about 40 points is about the 2345 or 2350 strike. So I'm going to sell, I'm going to give it a little bit here. I'm going to sell the 2350 strike. Actually, I'm going to come in one. I'm going to sell the 2345. So I'm holding the control key down on my keyboard. I already put in the order to buy the 2295 on the long side. Now, I'm sorry, 2290 on the long side. So now what I'm doing is I'm selling this one that expires on the 18th of August for $77.55. Okay, $77.55. Let's do the math here for just a second. So 2345 minus 2290 is $55. Now we're buying this debit spread essentially for more than the width of the spread. But the reason for that is we have an expectation that this is going to get more expensive, and we're going to be able to roll this a couple of times. So buying this diagonal spread for more than the width of the spread might be okay as long as the market helps us out in terms of that movement. So what I'm going to do is I'm going to click on confirm and send here. But before I do that, let's do this. Right click, analyze the trade, and we're going to put this on. I don't think I have another position. Let's just do hide positions. And here's what this trade looks like. So at its outset, the first iteration of this particular trade, we want price to go up into this range right here. The problem is if price goes really far up, really high up in this range, if price goes above, say, for instance, 2,500 on this index, then we're in a position where we're kind of locking in that loss. That's that width of that spread. So the intent is, since we're selling the front month with a shorter duration, that we don't have just kind of a static position here, that we're going to roll this as we get to expiration of that front leg, and we're going to buy down the cost of this spread by selling that front month 2 or 3 times. So we come back over here to the trade tab and we put that back down and we say, look, now, if realistically, if I were just going to do 5-day increments, I could roll from here to here. I could roll from here to here. I could roll from here to here until I get all the way out to that expiration that I was looking at, which was the 30-sep expiration. I could roll this essentially 1, 2, 3, 4 times and bring in premium each time. Now, rolls aren't guaranteed. Rolls aren't magic wands. Rolling a trade doesn't take away transaction costs or anything else. Rolling the trade simply gives us a convenient way to close one trade down and open another. And it depends on the liquidity in the target. Now, this is a pretty liquid index, so I'm not terribly worried about that. But that is kind of the process that we are looking at in this particular strategy. So let's come back down here. Let's open up this trade, our order entry tools down here at the bottom, and we're going to click on confirm and send. We're going to read through this order, make sure that we are aware of the transaction costs, make sure that we're aware of the trade that we want it to open, read the freaking order just so we know what we are doing. I did that yesterday in the futures class and did an inadvertent order that went against me, but it actually turned out okay. So read the order, click on send, and we sold that diagonal, or actually we bought that diagonal spread for $75. So we go back to our monitor tab. Here's that diagonal spread that is in our index options, and there's that one right there. So ideally, we want this to continue to get more expensive, right? To continue to get more expensive. Speaking of getting more expensive, there is that feedback survey right there in the chat. Do me a favor, fill that out, help us out, help us to make these sessions better. Last thing I want to do really quick, let's go back over here to the chart. Let's take a look at NDX. NASDAQ starting to roll off a little bit here. We've got a portfolio in our monitor tab here in this stocks group that is pretty heavy with kind of that broad cross section, but we do have some information technology. If we were to sort this by sector, you can see that we've got information technology and communication services here. We've got some big ones: CrowdStrike, Microsoft, AMAT, Avigo, NVIDIA, Verizon, Disney, and a few others here. So this has some relative sensitivity to the NASDAQ. So if we could beta weight this really quickly to the NASDAQ, let's beta weight it to NDX. And our sensitivity here is about 29 deltas. So let's see if we can remove some of those deltas, those NASDAQ deltas from this. So what I'm going to do is I'm going to go to the trade tab for the NASDAQ. And we can do this one of a couple of different ways. We could simply go out. Now, again, we know that we're coming into the tail end of earnings season. We know that, there's the potential over the next couple of weeks. I'm not going to go out terribly long in terms of duration on this trade, but I am going to go out with a little bit of duration here. I'm going to go out to, in this case, I'm going to go out to the 30 September expiration again, 48 days to go. And I'm going to look at buying a put option. Now, this is going to be expensive protection. But what I can do is I can look and see where my deltas are. So I've got about, if we go back to that monitor tab, 29 deltas, NASDAQ deltas. How would I get rid of, let's say, 50% of those deltas, right? How would I get rid of 50% of those NASDAQ deltas, reduce that sensitivity by 50%? So let's round it. That's 30 deltas. So we want to get rid of about 15 deltas. So what we're going to do is we're going to come back up here. We're going to go to our strike prices, and I'm going to put in a few more strikes. And I'm going to say, where do we get to about the 15 delta? And that's out here at the 22,275. And if we were to buy this option, now it's an out of the money option, right? This is extrinsic value. This is going to be a sunk cost generally. We don't expect to make money on the hedge. But what we're doing is by buying this one, we are reducing the sensitivity of this portfolio to the movement of the NASDAQ, because this is going to gain value if the NASDAQ goes down. So if I left click on the ask price here and we queue this order up and we read through this order, we see that, hey, this is going to cost me in this trade $14,000. That's a pretty expensive hedge for 15 delta reduction. Can we do better? Can we do better? Yeah. So if we were to, say, for instance, create a spread, for instance, to take some of that delta sensitivity off and offset that downward movement. What if, say, for instance, we were to come over here and we were to create an out-of-the-money call spread? So let's do that. Let's see if we can do an out-of-the-money call spread, which would benefit if the price of the index goes down. So let's see if we can kind of match that up. Let's go to a 30-cent delta. Let's go to the 24,600. We'll sell that one. And we will buy this one right here, 15-cent delta. And let's just sell this one really quick. We're going to bring in a credit. Let's do this. I know we're just about out of time. Let's put it in our index, our stocks group, which is the one we're hedging off. That sold. I'm going to show you the result of this really quick. We're going to pop back over here to the monitor tab, and that reduced our deltas by about half, and we got a credit for it. So we're getting paid for it. But we got to remember, that could go against us pretty quickly. Hey, if you want to learn more about this, jump into our webcasts. Come over here to schwab.com/coaching. Also, join us. By the way, we've got an event coming up in Chicago this weekend. Then we're going to be in Washington, D.C. This is the one I really wanted to tell you about. If you're in the Dallas area, our next market drive is coming up on September 20th. Click right there. It is free for you to attend. And if you want to learn more about our index option strategies, jump in here to the Trader Talks webcast page. My thanks to Cameron May for helping out and for being a part of this conversation. I want to answer one last question here, which Health Question asks, why not attempt to get rid of all 29 deltas? Because the index is still moving up a little bit, still in an uptrend. So I don't want to take away all of that sensitivity. I just want to reduce a little bit of that sensitivity. And in that particular case, I want to leave a little bit of that bullish sensitivity in place. Guys, thanks very much for joining me today for this webcast. Thanks, Cameron, for helping out. Thanks to all of our great production staff for helping with this as well. Again, fit that feedback survey, follow us on X, click on the subscribe button. You know all of the things to do. We'll see you guys again next week. Take care, everybody. Bye-bye.